Welcome everyone. Today we are going to dive into the Frankie candle's volume profile. This is an incredible tool that can help traders like you find key price levels and understand what is really happening in the market. By the time we are finished, you will know exactly how to set it up, read it, and use it to make trading decisions that are smarter and more informed. Imagine having the power to see exactly where traders are taking their biggest positions, where they are placing their bets, and where the market's battle lines are drawn. That is exactly what the Frankie candle's volume profile allows you to do. First, let us cover what exactly the Frankie candle's volume profile is. It is a variation of the classic volume profile tool, but designed to be more user-friendly and visually intuitive. This tool is made to help you see where the majority of buying and selling has happened. By doing this, you can spot areas of strong support and resistance, which can help you understand where the market sees value. Picture it like a heat map, but for price levels. It highlights where all the action is, where traders are placing their bets, and where the battle lines between buyers and sellers are drawn. Now, let us take a closer look at some common chart patterns that you will come across when using the Frankie candle's volume profile. Understanding these patterns is crucial for interpreting what the market might do next. One important pattern is the double top or double bottom. A double top is when price reaches a high point twice and fails to break through, which often signals that a reversal is about to happen. The double bottom is the opposite, where price hits a low point twice and then moves higher, signaling a potential bullish reversal. Both of these patterns are more powerful when they occur near a significant volume profile level, like the point of control or the value area high or low. Another critical pattern is the triple top or triple bottom. A triple top forms when price tests the same resistance level 3 times without breaking through, which suggests a likely bearish reversal. On the other hand, a triple bottom forms when price tests the same support level 3 times, indicating a possible bullish reversal. When these patterns appear near volume profile areas such as the point of control, they become even more significant due to the increased trading activity at those levels. The head and shoulders pattern is another classic reversal indicator. This pattern occurs when the price forms 3 peaks, with the middle peak being the highest, resembling a head between 2 shoulders. This pattern is often an indication that a bullish trend is about to reverse into a bearish one, especially if it occurs near a major volume level like the value area high. The inverse of this pattern, the inverse head and shoulders, signals a potential bullish reversal and forms after a downtrend, often indicating the beginning of a new upward movement. Triangles are another essential chart pattern to recognize. There are 2 primary types, ascending and descending triangles. An ascending triangle forms when the price makes higher lows while meeting resistance at a horizontal level. This pattern often suggests that buying pressure is building and a breakout above the resistance is likely. Conversely, a descending triangle forms when price makes lower highs while finding support at a horizontal level, indicating increasing selling pressure and a potential breakdown. These patterns are particularly powerful when they align with significant volume levels, such as when a breakout occurs through a low volume node, providing strong momentum. Next, we have wedge patterns, which can either be rising or falling wedges. A rising wedge forms when the price makes higher highs and higher lows, but the range narrows, often signaling a bearish reversal. It is most effective when appearing near a key resistance level like the value area high. A falling wedge, on the other hand, forms when the price makes lower highs and lower lows, and the range narrows, This pattern usually signals a bullish reversal, especially when it forms near a significant support area like the value area low. Rectangles are another continuation pattern to be aware of. This pattern occurs when price moves between two parallel support and resistance levels for a period of time, indicating consolidation. Price typically breaks out in the direction of the preceding trend. When a rectangle forms near a key volume level, it often provides a strong continuation signal once price breaks through either boundary. Flags and pennants are also common continuation patterns that traders should watch for. A flag forms after a strong price movement, resembling a small rectangle that slopes against the prevailing trend, while a pennant looks like a small symmetrical triangle. Both of these patterns indicate a brief consolidation before the trend continues. These patterns are most reliable when they occur near a key volume node, as the volume acts as a confirmation that the trend will resume. Lastly, the rounded bottom or saucer pattern is a long-term reversal pattern that forms as the market slowly shifts from a downtrend to an uptrend, creating a rounded shape. This pattern is particularly effective when it appears near significant support areas like the value area low, signaling a gradual build-up in buying interest. Traders should look for increased volume during the breakout, as this suggests momentum is building and confirms the strength of the new trend. By thoroughly understanding and recognizing these chart patterns, especially when they appear around significant volume profile levels, you will enhance your ability to make informed trading decisions. These patterns, combined with volume insights, give you a clearer picture of the market dynamics and allow you to exploit high-probability trading opportunities. Another pattern to look out for is the head and shoulders pattern. This is a classic reversal pattern that occurs when price forms three peaks, with the middle peak being the highest. It looks like a head with two shoulders on either side. When you see this pattern forming near a high volume area, it can indicate that the market is about to reverse its current trend. The opposite version of this is called the inverse head and shoulders, where the pattern forms at the bottom of a downtrend and signals a potential move higher. Triangles are another important chart pattern. There are two main types: ascending triangles and descending triangles. An ascending triangle forms when the price makes higher lows but meets resistance at a horizontal level. This often indicates that buyers are gaining strength and a breakout to the upside could be imminent. A descending triangle forms when price makes lower highs and finds support at a horizontal level, suggesting that sellers are gaining the upper hand and a downward breakout may occur. Both of these patterns are especially effective when they align with volume spikes or low volume nodes, as these volume levels can provide the necessary momentum for a breakout. Finally, keep an eye out for flags and pennants. These are continuation patterns that often form after a strong move in one direction. A flag looks like a small rectangle that slopes against the prevailing trend, while a pennant looks like a small symmetrical triangle. Both patterns indicate that the market is taking a brief pause before continuing in the original direction. When these patterns occur near key volume levels, they can offer great opportunities to join a trend with a defined risk. By understanding these chart patterns and knowing how to combine them with the insights provided by the Frankie candle's volume profile, you will have a much clearer picture of what the market is doing and be better prepared to take advantage of trading opportunities. Keep practicing and you will start recognizing these patterns more easily, allowing you to make more informed trading decisions. Now that you have an idea of what it does, let us talk about getting it set up. You are going to need to access this indicator on your trading platform. It is usually located under Volume Tools or Market Analysis Tools. Once you have it loaded, you can customize the settings. If you are a day trader, you might want to use shorter time frames, like the 1-minute or 5-minute charts. This will help you focus on the immediate action. If you are more of a swing trader, then longer time frames, like the daily or 4-hour charts, are going to give you a better overall picture. Make sure you adjust it in a way that works for you. Next, let us break down some of the key parts of the volume profile. You have what is called the point of control, or POC. This is the price level where the most volume has been traded. It is like the heart of the action, a kind of battleground where buyers and sellers are most active. Knowing where this level is helps you understand where the market is finding a lot of interest. Then there is the value area. This is the range where about 70% of trading volume takes place. It is bounded by the value area high and the value area low. These are important because they represent where most of the buying and selling has happened. These areas can act as strong support and resistance. If price moves beyond these levels, it is often a sign that something significant is about to happen. In addition to understanding the key parts of the volume profile, recognizing certain chart patterns can further help you predict potential market movements. One common pattern is the cup and handle. This pattern resembles the shape of a teacup, where price gradually moves in a rounded bottom, forming the cup, and then consolidates slightly downward, forming the handle. This is typically a bullish continuation pattern, and when it forms near a significant volume level like the point of control, it can signal a strong move to the upside once the handle breaks out. Another chart pattern to be aware of is the wedge pattern. There are two types of wedge patterns: rising wedges and falling wedges. A rising wedge occurs when the price forms a series of higher highs and higher lows, but the range narrows over time. This pattern often leads to a bearish reversal, especially if it occurs at a high volume level, such as the value area high. Conversely, a falling wedge forms when price makes lower highs and lower lows within a narrowing range, usually signaling a bullish reversal if it appears near support areas like the value area low. Then we have rectangles, which are continuation patterns that form when price moves between two horizontal support and resistance levels for a period of time. This pattern indicates consolidation, and price tends to break out in the direction of the prevailing trend. When these rectangle patterns form near key volume nodes, they can provide reliable signals of continuation or reversal depending on the breakout direction. One more pattern to look for is the triple top and triple bottom. The triple top forms when price reaches the same high 3 times without being able to break through, which often signals a bearish reversal. The triple bottom, on the other hand, forms when price hits the same low 3 times and suggests a potential bullish reversal. These patterns become even more powerful when they align with significant volume levels, as they show that the market has repeatedly tested these areas but lacks the strength to move beyond them. Lastly, watch out for the rounded bottom or saucer pattern. This pattern is characterized by a slow, gradual shift from a downtrend to an uptrend, forming a rounded shape. It is often a long-term reversal pattern and can be very effective when it forms near significant support areas, such as the value area low. Traders can look for volume confirmation during the upward move, which signals that buyers are stepping in and that momentum is building. By incorporating these chart patterns into your use of the Frankie candle's volume profile, you will be able to spot more trading opportunities and improve your market analysis. Keep practicing recognizing these patterns, and you will find that they become a valuable addition to your trading toolkit, allowing you to make more confident and informed trading decisions. So how do you read the Frankie candle's volume profile? Let us talk about the high volume spikes first. When you see a spike in volume at a specific level, it means that both buyers and sellers are active there. These levels often become strong support or resistance. Imagine price approaching one of these levels. The more volume you see, the harder it will be for the price to break through. Then we have the low volume nodes. These are areas where price moved quickly and there was not much trading interest. Price tends to move very fast through these zones, which makes them ideal for breakout trades. Think of them as low resistance zones, where price can travel freely without much friction. Now let us discuss a few strategies for using the Frankie candle's volume profile. One strategy is to trade support and resistance based on the point of control. If price is testing the point of control and holding, it may act as support or resistance. You can consider entering a trade by buying near support at the point of control or selling near resistance. It is all about using these key levels as opportunities. Another strategy is breakout trading using chart patterns in combination with low volume nodes. For example, if you identify an ascending triangle pattern forming near the value area, you can wait for a breakout above the resistance line. If this breakout occurs through a low volume node, price tends to accelerate due to reduced resistance. The same idea applies to descending triangles during a downtrend. Breakout trading through low volume nodes can be powerful, as price movement tends to be fast and decisive. You can enter the trade as the price leaves the value area and look to exit at the next high volume area. Additionally, understanding continuation patterns such as flags or pennants is important. If you see a flag forming after a strong move and the price is consolidating near a significant volume level, this can be an ideal setup to enter with the prevailing trend. Breakouts from these patterns can often align with low volume nodes, creating opportunities for high probability trades. Lastly, keep an eye on trend reversals at key levels like the value area high or value area low. Patterns such as the head and shoulders or double top and bottom often signal a reversal, particularly when price reaches a volume profile boundary and struggles to break through. If you spot a head and shoulders pattern forming near the value area high, for instance, and price is unable to surpass this level, it could be a sign of an upcoming downtrend. This can be a great opportunity for a contrarian trade if you catch it at the right moment. Combining chart patterns with the insights of the Frankie candle's volume profile helps add layers of confirmation, making your trades more informed and reducing risk. Understanding how different patterns behave at key volume levels will significantly improve your market analysis and enable you to take advantage of a variety of market conditions. Now, you might be wondering how you can strengthen your analysis with this tool. The Frankie candle's volume profile works even better when you use it along with other indicators. Overlaying moving averages on your chart is a great way to confirm trend direction. For example, if the price is above the moving average and near a high volume zone, this could be a good signal to go long. Moving averages can also help you identify dynamic support and resistance levels, which can be especially useful during trending markets. Another powerful tool to combine with the volume profile is the Relative Strength Index, or RSI. The RSI helps confirm whether the market is overbought or oversold. When the price reaches a key volume profile level and the RSI shows extreme levels, this is a strong indication that a reversal might be imminent. It is even more compelling if the RSI forms a divergence, such as when price makes a new high but the RSI does not, signaling a potential weakening trend. You can also use the MACD or moving average convergence divergence to further enhance your analysis. The MACD can help spot changes in momentum. When the MACD crosses over and aligns with a significant volume level, such as the point of control, it can provide a solid signal for entry. This indicator is especially useful for identifying the start of new trends or potential reversals. Lastly, consider combining the volume profile with Fibonacci retracement levels. When a Fibonacci retracement level coincides with a high volume node, it reinforces that level as a significant support or resistance area. This confluence provides a much stronger signal for a potential bounce or reversal. Using Fibonacci in combination with volume insights allows you to better gauge where the market might react. Using these tools together creates a multi-layered approach to market analysis, making your strategy more robust and helping to filter out weaker signals. By stacking the probabilities in your favor, you increase the likelihood of making successful trades. Let us talk about risk management. This is an important part of using the Frankie candle's volume profile. Always make sure to place your stop loss just outside the key volume levels. For example, if you are buying near the point of control, you would want to place your stop just below the value area low. This protects your position if things go against you. Position sizing is also key, especially during breakouts. Low volume zones can lead to very quick movements, so keeping your risk controlled is important. Also, think about setting your take profit zones at the next high volume area or at key levels like the value area high and low. These levels tend to act like magnets, drawing the price toward them, which makes them great places to take profit. There are a few common mistakes to watch out for when using the Frankie candle's volume profile. One mistake is overlooking low volume areas. These areas can often lead to rapid price moves, and if you are not prepared, you might miss out on an opportunity. Make sure you understand the significance of these low volume zones and use them to your advantage for potential breakout trades. Another mistake is ignoring chart patterns that form around key volume profile levels. For example, if a head and shoulders pattern forms near the point of control, it could signal a significant reversal, but ignoring these patterns can result in missed opportunities. Chart patterns like triangles, wedges, and rectangles should be closely monitored, as they often align with volume profile levels to indicate stronger potential trades. Another mistake is ignoring the bigger picture. Remember, volume profile is just one tool. It is important to always think about what else is happening in the market. Are there any big news events coming up? What is the general trend looking like? Are there other technical indicators like moving averages or RSI that support your analysis? These factors can have a huge impact on how price moves around these levels. Combining different tools and patterns will give you a more holistic view of the market. And finally, do not jump into trades without proper confirmation. Just because the price is approaching a high volume node does not mean it is time to trade. Wait to see how price reacts first, and look for a solid confirmation signal before you make your move. Confirmation can come in the form of candlestick patterns like pin bars or engulfing candles that signal a likely reversal or continuation. Always be patient and wait for clear signals before risking your capital. Here are some practical tips that can help you get started using the Frankie candle's volume profile. Start by looking at longer time frames. This will help you get a feel for how the price moves around these volume levels without getting overwhelmed by the noise of shorter time frames. Longer time frames also help in identifying major chart patterns such as double tops, head and shoulders, and wedges, as they are more visible and reliable when confirmed over extended periods. Use your platform tools to set alerts at key levels like the point of control, value area high, or value area low. These alerts will allow you to monitor critical price movements without needing to stay glued to your screen. When price approaches these levels, look for accompanying chart patterns like flags, pennants, or triangles, as these can provide further insights into the market's next move. For instance, a flag pattern near the value area high could be a continuation signal, offering a well-defined setup. And lastly, always look for confluence. The more things that line up in your favor, like volume profile levels, moving averages, trend lines, and recognizable chart patterns, the stronger your trade setup will be. For example, if a rising wedge is forming near the value area low, and you also see RSI divergence, this confluence greatly increases the probability of a successful trade. Remember, strong confluence leads to better risk management and higher confidence in your trades. Let us quickly recap everything we have covered today. The Frankie Candles volume profile is a fantastic tool for finding key price levels where the most trading has taken place. Keep your eye on the point of control, the value area, and low volume nodes, as these are your main guides for identifying potential trades. Make sure to use other indicators to confirm what the volume profile is telling you, and always think about risk management before you enter any trade. This is a tool that can make a big difference in your trading, but like anything else, it takes practice. Keep refining your skills, and soon you will be able to use the Frankie Candles volume profile to boost your trading performance.